Joining me now at the Property Investor Show, it's Robin Pilley of CXGinvest. So welcome, Robin. You've got a very busy show, haven't you? Because you've got your stand, you've got seminars. What are you going to be talking about?
Well, today I'm talking about how you can increase your returns on investment properties and how you can build a portfolio, hopefully to reach your financial freedom goals in about a 5-year time span.
Do you have any sort of favourite areas to invest in the UK that you feel there are the highest yields?
Well, last year we started to source a lot of properties in the northwest, both Manchester and Liverpool. We've also done quite well in Sheffield. So we've kind of looked and hunted down areas where the yields are very attractive. Obviously, there started to be a contraction of yields in the south, particularly London last year. And when I first started to talk about Manchester and Liverpool, it's like I was talking about Mars. People were quite reticent to go up there. But I would say about September last year, that we noticed that people were a lot more receptive. We started to recommend more and more people. We've partnered with some very good developers up there, and our investors have done very, very well. We sold 11 units, 4-bed houses in Manchester, where they purchased them at 160, and now the valuations are over 200,000, and that uplift has come almost immediately on the completion.
So these are houses rather than flats?
Well, we sell houses and flats, studios, as well as student pods as well. So we like to feel we've got something for everybody, really.
And what's your view on the kind of lower value properties under 50k? Do you see there's opportunity there?
Yes, there can be. I think the thing to be careful of is that when developers are guaranteeing returns, is to make sure what is the guarantee worth, as in, is it set against the trading company or as a separate company being set up which has no assets in it, and if the investor doesn't get the returns he's been promised, and he ends up having to sue that company, he finds that there's nothing there, and all he does is cost himself a lot of money and brings that company down, and obviously everybody loses out. So that's really where the due diligence side of things are very important. Obviously we try to do due diligence, but at the end of the day it's always the investor who's going to get left with the asset, so it's very important that he feels comfortable himself before he invests in those type of properties, because quite often they're cash purchases, so the risk can obviously be higher because he's not getting a survey by a bank. So, there are stories where people have obviously lost money, maybe trusting the wrong developer. So that's obviously very, very important.
Yeah, you mentioned about capital growth, but you yourself always preach cash flow as well. Are you still banging that drum?
We're still banging that as loudly as we ever were, really. I think what's happened over the last 6 or 7 years, hopefully, is shown the benefit of making sure you purchase for cash flow. In our area, in Haverhill, for example, we were sourcing properties at the height of the market, 2008, for about 125,000 under stamp duty. All of a sudden, obviously, the financial crash came, which nobody predicted. The valuations went down to 80,000. Now, obviously, some people might panic at that, but because we'd recommend purchasing for cash flow, they didn't become motivated sellers. They didn't need to sell, and of course, their rents actually started to go up. And within months, interest rates came down like a stone, so their cash flow actually increased. Yep. And now those properties are getting valued at about 150, 160,000 a few years later. So they totally rode the storm out. And of course, their cash flow now and their yields are at about 12 or 15%. So they're very, very happy. But had they not have bought for cash flow, and they'd have bought those properties for 125,000 and then left any, and they'd mortgaged themselves, maybe got 125% mortgages, all the things that were on offer at that time, they probably would have sold and lost a lot of money.
Indeed. So just to finish, Robin, what would be your number one tip for landlords in 2015?
My number one tip is really to just make sure that you open your eyes up. Don't just concentrate on your own area, which I know a lot of people do, because especially in the south, you might find that the yields are really beginning to reduce down. So just open your eyes up and maybe go away and get a little bit out of your comfort zone, because there's some massive opportunities in the northwest, and I still feel the capital appreciation is there to come over the next few years. Because, for example, they're about 40% below the peak we were talking about, whereas London's 40% above. Now, in historical terms, that's bigger than it's ever been.
Yeah,
So,
well, there's potential for growth, isn't there?
yes, and of course the entry points are lower, yields are higher to begin with. So, there's lots of positive factors, but it's just, in the end of the day, making sure your investment, of course, is very well managed.
Of course. Very good point. All right, well, thank you
Okay.
very much for joining us, Robin. Nice to see
Thank
you.
you. Brilliant.